Hello, welcome to the course Security Investment Case Analysis under Global Vision. The name of the course seems a little bit long, but it does capture the core features of this course. So simply from the name of the course, we can quickly get three key factors. The first one is security investment. Of course, this is a course on investment, but we only focus on securities. Second key features is the case analysis. That means this course will be full of case studies. Third keyword, under global vision. The case studies in this course come from not only mainland China, but also China, Hong Kong, Japan, Korea, United States of America, even India and European countries, including Germany and France. The topics today will focus on how to analyze stock return and risk. Different from traditional perspective, the analysis here will have two new perspectives. One perspective from the dynamic of stock return and risk. Another perspective from investment return and risk. Topic 5 today. We will study daily return versus periodic return. Topic 6 today, we will compare the periodic returns of two stocks. And topic 7, we will introduce a new concept called holding period return, HPR, or simply holding return. While some of the textbook will describe HPR as investment return. Let's look at topic 5, daily return versus periodic return. The topic questions in this topic is, we have two questions. What is the daily return of a stock? And what is the periodic return of a stock? Both concepts focus on stock return, but their calculation methods are totally different. Daily return is the base, and periodic return is calculated based on daily return. They have different advantage and disadvantage. Please be aware about that. In order to introduce these two concepts on return, we will use IBM as an example. In my age, IBM was a very famous company, very famous. There are several classic products from IBM. For example, the ThinkPad, famous ThinkPad. Of course, ThinkPad was acquired later by Lenovo. The first laptop I ever used was a ThinkPad, which is P40. P40 is a very classic one. At that time, I liked that ThinkPad very much. Especially, I like the feelings of touch the keyboard of the laptop. Also, the personal computer we call PC today was initially introduced by IBM as well. So this one is called IBM PS2. PS2, very classical personal computer. And this one is called mainframe. Mainframe. It means huge computer, supercomputer. So its model is called S390. Nice. This computer is the data center of many financial institutions, such as banks, such as insurance companies, such as credit card companies. Also, for many countries, this computer is the data center of some of the social insurance institutions as well. So the feature of this machine is high reliability. Very high reliability. Okay, of course, it is very costly, very costly. very expensive. Okay. This is the products of IBM. This figure describes the daily return and periodic return of IBM starting from January 2019 until the end of 2019. And in this graph, the solid blue line represents for periodic return. Periodic return. Here is the annual return. Annual return. While the orange dot line is the daily return. It's the daily return. From these two curves, what can we find? Apparently, from the daily return, we are difficult to find out any useful information. Useful information. It's too difficult to find out. It's just like earthquake waves. It's very hard to find any useful information. However, when we convert the daily return into periodic return, we do find something. We do find something such like this. If I draw the trend line, we can quickly find out a useful information upon each trend. Upon each trend. Okay. So in general, the trend of IBM annual return is going up. That means it is an upward trend. This is a very important signal in security analysis, and it is a very useful information. Very useful information. Especially for mid-term and long-term investment, this information is pretty important. Okay. And that means during this period, IBM stock is worth for investors to hold in mid-term and long-term. So this information is important enough for investors, right? Now let's look at the concepts of daily return versus periodic return. Okay. The daily return is the return every business day or every trading day. It's a daily basis. While periodic return is on weekly basis, monthly basis, quarterly basis, as well as annual basis. What are their differences? And what are their advantage and disadvantage, respectively? So let's look this into details, because these two concepts are among the most important concepts in this topic. First, let's look at daily return. Daily return. How do we look at daily return? How do we calculate daily return? Suppose these are the dates. We suppose these are the trading dates or business dates. And this is day 1, this is day 2, day 3, day 4, day 5, day 6, 7, 8, blah, 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 blah. And this is day N. Whenever we calculate daily return, we simply use this way. For example, the daily return equals to, suppose the stock price on day 1 is P1, then P2, P3, blah, blah. And the return is R2, R3. Blah. So how to calculate R2? R2 is calculated this way. P2 minus P1 divided by P1. Yes. This is called daily return. By this way, we can calculate a series of daily return. It's called this way. R2, R3, blah, 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 Rn, Rn. Okay. So in statistics, all these concepts are actually the ones in statistics. In statistics, one single record is called an observation. One observation. Okay. All the observations together, we call them a sample. A sample. Okay. This is an observation. And the sample is trying to describe the features or characteristics of a population. A population. Of course, these are the concepts in statistics, but not the focus of our course. Just we have a brief review on this. Now that we have understand daily return, but what is periodic return? What is periodic return? Okay. First, periodic return is based on daily return. While in periodic return, we introduce a new concept called window. Window of observations. Window of observations. Now, let's look at carefully. These are the key concepts of window. Okay. Let me erase all these things. We will draw windows of observations based on this. Okay. Yeah. Here we have R2, R3, R5, R6. Yes. Okay. Suppose we have a length for windows. A length for windows. And we are now expecting to use a weekly based return, a weekly based periodic return. So every week, we suppose we have 5 trading days or business days. In this way, the length of our window is 5. Is 5. Now we have 5, 2, 3, 4, 5. Okay. These 5 observations, we call them windows 1. And starting from the second point here, this will call them windows 2, windows 3, windows 4. Now, we have a new observations, a series of new observations. So observations is usually abbreviated as OBS. And this new series of observations, we have a new sample. This new sample is composed not the price of stock, not the return of stock, but the return of stocks in a series of windows, a series of windows of observations. So these observations, we suppose they are daily return. For this window, we can have 2 ways. The first way is we use the mean of daily returns. Another way, we can use the cumulative return. Cumulative daily returns. So cumulative, the word cumulative here means we sum up. The way we sum up here is, for example, we have, suppose it equals 1 plus R. For example, I equals 1 to 5. Yeah, this way. This means times. We times all these together. This is called a cumulative return. Cumulative return. Another way we can have a mean of daily return this way. 1 plus R. No. Okay, we still have to minus 1 here. So this is called the mean of the daily return. During the period. Okay. Of course, this is during the period as well. Now we have an idea on periodic return. So next, let's try to imagine what are the advantage and disadvantage. This one is daily return. This one is periodic return. The significant advantage of daily return is its dynamics. Yeah, it is very it is very dynamic. It's very dynamic. It can reflect, describe the daily changes, the daily dynamics of return, almost in real time. Well, its disadvantage is there are too much occasional implications. Occasional implications by many factors. By many factors. In this way, we are very difficult to read out useful informations. Difficult to get useful informations. Then let's look at periodic return. Periodic return is we either sum up or accumulate daily return during a period, a week period, or a monthly period, or an annual period. In this way, we can eliminate the effect of fluctuations caused by those occasional factors. Therefore, we can easily find out some of the useful informations. Easy to find useful informations. Especially the trend information. Especially the trend information. So it would be very useful in trend analysis. Trend analysis. As it is easy for us to find out useful information, whenever we try to compare the performance of two stocks, periodic return can also help us quickly find out the differences between two stocks. The difference between two stocks, between the performance of two stocks. In this way, periodic return could help us a lot from two perspectives. First, trend analysis. Second, comparative analysis. and comparative analysis. Okay. This will be here. Okay, sorry. It is the advantage of periodic return. So what are the disadvantages of periodic return? Okay, it's not that dynamic. In this way, periodic return is not very suitable for short-term dynamic analysis. Okay. So, for example, if you expect to observe the fluctuations of a stock last week, so in this situation, it is not suitable for you to use periodic return. It is suitable for you to use daily return. Okay, these are the concepts. Do we have any questions? If no, let's look at the Python scripts to make these pictures. First, we use this one to enable the function of CHEN. Again, CHEN is a functional plugin in Python. Its purpose is to enhance the functions of Python in the area of security analysis. This is the command compare stock. The Python code. It's a Python command. Its function is to compare two stocks between two measurements, two situations. First situation, one stock, two measurements. For example, we compare Jingdong stock for the relationship between close price and open price. So this is one stock, two measurements. Another situation is two stocks, one measurement. One measurement. For example, Jingdong versus Alibaba for their close price. Here we have one stock, which is IBM, but we have two measurements. One is daily returns, another is annual return. Then we need a period of time. In any period of time, we need a start date. Here we have 2019, January the 1st, and an end date, which is December the 31st of 2019. Now, let's do it together. First, I need to copy the command into Jupyter Notebook. I click New here, and Python. Now, I will start a new Jupyter Notebook window. This is called a command line. The first command we need to key in is from CHEN import star. Here star means everything. We have a star here as well. This star means the command is being executed by Python. If no message appears, everything is okay. Okay, this is the command. Again, this is the Python command. This is the variable. I repeat, The variable here is to store the data returned by the Python command. Here, the data returned by Python command includes IBM stock information. In detail is the price information, stock price information. But focus on two measurements. One is daily return, another is annual return. And the period is from January the 1st, 2019 to the end of the year. Let's do this command first. Then we will change the date to this year and we will see the new dynamics of IBM. In order to execute a Python command in Jupyter Notebook, we simply press the key Shift and the key Enter together. Now the Python command began to work. It gives us many messages. Okay, now we have the results. So the internet connection speed is quick this morning. This graph is exactly the same as we have in our slides. Now, I expect to update the information of IBM stock into this year. First, we copy the command to a new line. Then I change the date to 2022. 2022. Here we have July. Here we have 12. Now let's look at this way. This message given by the command saying first, okay, searching price for corresponding securities, please wait. Please be aware, if your internet connection speed is slow, this command may need more time to have this picture. Now let's look at this picture. All the other things are the same except the trends or the curves. And this is the orange dot line is still the daily return. And the blue solid line is the annual return. In this picture, we find a totally different trend in this period, starting from January 2022, compared to the situation in 2019. So in this way, we can easily find out the changes of trend of IBM stock in different periods, and then we can easily make a comparative analysis. Generally speaking, starting from this year, the trend of IBM stock's return is basically a downward before June. And after June, we see a bounce back. So this is the most important and most useful information we get from this picture. While from the daily return, it's still hard for us to find out useful information. Okay. So this is the value of periodic return. Let's back to the slides. Let's do an exercise case together. Describe and compare the stock daily return versus the periodic return for a new stock called Facebook, starting from 2020. Let's do the case together. I copy the command. I change the stock code here from IBM to Facebook. The stock code for Facebook is FB. And the starting date here is 2020 as requested in the exercise case. Now let's look at the results. Before we have the results, what do you think about the trend of Facebook stock return? Is downward or upward? Of course, before we conduct a trend analysis, we have no idea on the answer. Now let's look at we have to wait a few seconds. Wow, this is pretty interesting for the stock Facebook. For the periodic return starting from 2020 January until today. Similarly, we are also difficult to find out any useful information for the daily returns. It's just like a wave, an electronic wave, wireless wave. However, if we look at the periodic return, we can clearly tell something about the trend. The trend starting here, then up. Now we have local ceiling points here, then goes down. Then we have local floor points here. And then we have a steep uprise. And we have a new ceiling here. And then down, 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 down. Until today. So this is the trend. Then we find out something more important here. It is the return, it's the turning points. It's the turning line, or it is a critical line. Above the line is positive return. Below the line is negative return. And negative return means loss. It's loss, right? The positive return means earnings. So in order to further understand the graph, we can also say something about the part of periodic return of Facebook stock for their negative returns, this part. We find out that after, roughly at the beginning of this year, Facebook's periodic return is now below zero. In other words, it is a negative return now. At least for the moment, it is not worth for investors to invest on Facebook stock. From the beginning of this year till today, it is only a midterm. We have no idea about its long term to the future, but at least from the midterm perspective, we can have our conclusions and we can have our advices to investors. Be very careful about Facebook stocks. If you expect to buy in, no, we don't suggest you buy now. Let's back to our slides. Now that we have the concept of a very useful new term called periodic return, and then we can use periodic return to do comparative analysis. I must say that all the comparative analysis in this course are, in the meantime, trend analysis as well. This is the question in this topic. This topic, we will try to find out the solution on how to do comparative analysis for the return situation of two stocks by using the concept periodic return. Before we go to the case studies, let me introduce three concepts or three mindsets of periodic returns: short-term, mid-term, and long-term. In periodic return for long-term, we usually use annual return. For mid-term, we can use, for example, quarterly return, or sometimes monthly return. For short term, we can use weekly return or monthly return. So these are the three perspectives. Three purposes. This time we use two stocks, two famous stocks in China, although they are listed in United States of America. One is Jingdong, another is Alibaba. Both are e-commerce companies. This graph, we have the periodic return between Jingdong and Alibaba. And this time we use annual return, starting from the beginning of 2020 to the end of March 2020. In terms of the measurement, it's a long-term analysis. In terms of the period, it is actually a mid-term analysis, because we only analyze 3 months of these stocks, 3 months. The blue solid line represents for Jingdong, and the orange dot lines represents for Alibaba. From this stock, what can we tell? We can quickly tell several points. First point, in terms of annual return, Jingdong is higher. To our surprise, right? We usually think Alibaba is a very good company. But in terms of annual return, at least in this period, Jingdong is higher. Second point, their trends are similar to each other. I think because both are e-commerce company, they are in the same industry. And in this way, both top companies in this industry behave same or similar trends. That means these trends or the characteristics of these trends not only represents the two companies, but also the whole industry. So in this way, we can do an industry analysis. E-commerce industry in China. Okay. Very similar to each other. Third point, both companies' annual return are downward. Fourth point, Alibaba's annual return is now close to the critical zero line. It's close to the zero line. It's a strong warning. Or alert. Okay, so simply from this picture, we can quickly find out 4 points about useful information. In this way, the periodic return analysis is very simple, but it can tell us many useful informations, especially compared to daily return. Okay, now we have a 10 minutes break. See you after 10 minutes.